A very good morning to all of you students. Today we will be discussing on the topic of mergers and acquisitions and then on the startup finance. So let's start from question number 18 where we left. So till question number 17 and all the concepts we did in the previous two sessions students. So yeah, the following information is provided relating to the acquiring company Efficient Limited and the target company Healthy Limited. Efficient and healthy, they have given us the number of shares, market capitalization, P/E ratio, reserves and surplus, promoters holding. Okay, so this is, I think, the first question in which we are having something to call as promoters holding. Board of directors of both the companies have decided to give a fair deal to the shareholders, and accordingly, for swap ratio, the weights are decided as. Now, if we see, they have decided that there will be different let's say matrices to calculate the swap ratio, which are earnings, book value, and market price of the share of each company, and they have assigned the weights also to each of them, which is 40, 25, and 35. So, I mean, this question is indicative of the fact that there is no one way to calculate the swap ratio, right? It can depend on lot many things. Now, in this case specifically, they have given us the methodology. Calculate the swap ratio and also calculate the promoter's holding percentage after acquisition. So this is easy and simple. Versus they are asking us to calculate the swap ratio and what is the promoter's holding. Then what is the EPS of Efficient Limited after acquisition of Healthy Limited? What is the expected market price per share and the market capitalization of Efficient Limited after acquisition, assuming PE ratio to be the same? It remains unchanged. Okay. Calculate free float market capitalization of the merged firm. So let's go step by step, because the first thing that we have to calculate is the swap ratio. So for swap ratio, we need to understand what is the earnings per share, book value per share, and market price per share for both the companies. So let's compute them. So let's put both the companies parallelly, Efficient Limited and Healthy Limited. So their market cap, because market cap is indicative of the market price multiplied by the number of shares. So let's start with that. Market capitalization was how much for the respective companies? 500 lakhs and 750 lakhs. Right? So this is the market cap. The number of shares are 10 lakh and 7.5 lakhs. And 7.5 lakhs. So market price per share becomes how much then? If we divide these two, we will get the market price per share, which is 50 and 100. Then PE ratio is also given in the question, which is 10 and 5. So can I calculate the EPS using PE ratio and MPS? The answer is yes. So how can we calculate the EPS? EPS will become market price per share divided by the PE ratio, right? Because PE ratio is equal to MPS divided by EPS, right? So if we reverse the order, it will become MPS divided by PE ratio. So 50 divided by 10 is 5. 50 divided by 10 is 5. And 100 divided by 5 is 20. Clear? Then we have been given share capital, let's say face value of rupees 10 each, right? Now, if you see, we have calculated EPS, we have calculated MPS. Now we are left with the book value, right? Now, book value will take the reserves and surplus as well as the share capital, right? So, share capital is already given as 10 lakhs number of shares multiplied by 10 each for the face value, right? So, it becomes 100 lakhs. And similarly, here it becomes 7.5 multiplied by 10, which is 75 lakhs. Correct? So, it becomes 10 into 10 and it becomes 7.5 into 10. And then the next point is on the reserves and surplus, that is around 300 and 165. So this in totality becomes 400 lakhs and this becomes 240 lakhs, right? And then if we divide it by the number of shares again, we will reach at the book value per share. Right, so 400 divided by 10 lakhs, it becomes 40, and 240 divided by 7.5, it becomes 32. Right, now let's calculate the swap ratio. So now swap ratio they have given as the weights, right? So let's start with the, let's say, number one thing, which is the EPS. I'm just putting here the column headers. So basis earnings, right? Basis earnings, the EPS is how much? Yeah, this one. So 20 and 5, right? EPS of the target company divided by EPS of the acquiring company, right? That is what the swap ratio is. 20 divided by 5, which is actually 4 is to 1. And the weight assigned to it is 40%. So 40% multiplied into this ratio becomes 1.6 is to 1. Then the next one is book value. Book value again, we have 32 and 40, right? 32 divided by 40, which translate into 0.8 is to 1. And here it is 25% weights. So 25% into zero point 0.8, it will become 0.2 is to 1. Then the last part is MPS, market price per share, right? Which is 150. So 2 is to 1. 100 divided by 50, which translates into 2 is to 1. The weight is 35%. And here it brings out to be 0.7 is to 1. So the total is 0.9, 1.6, 2.5 is to 1. Right? So this is the overall swap ratio. So I think the first part is done. So first A part is done, I think. The second part they're asking about the promoters holding. So this is the first A part. Now promoters holding percentage after acquisition. It's easy now, right? So first B part, which is the promoters holding. Number of shares held by promoters post merger. So if we want to see how many were they originally they were 4.75 and 5 for healthy. So 4.75 will remain as is, right? Because these are for the efficient limited. So these are 4.75 plus 2.5 into 5, right? Because 2.5 is the swap ratio and 5 are the original ones. So this will become 12.7, 12.5 plus 4.75, which is 17.25 lakhs. Okay. And so this is, let's say, the first part. Second part, we also need to calculate the total number of shares post merger, right? So these are 10 lakhs plus 2.5 times 7.5 lakhs, correct? So these are the total number of shares, which is 28.75 lakhs. So percentage promoters holding becomes how much? Promoter shares divided by the total shares. 17.25 divided by 28.75, which is equal to 60%. Clear? Now the second part is asking us to calculate the EPS of Efficient Limited after acquisition, which is again easy. EPS after acquisition will be 50 lakhs plus 150 lakhs. These are the earnings, right? If we see while calculating the EPS, okay, we can mention it. So EPS is how much? EPS is 5 and 20, right? So 5 multiplied by, let me say, earnings for Efficient Limited. So 5 is the EPS and 10 lakhs are the shares. So 50 lakhs become the earnings. Similarly, for Healthy Limited, which is the target company, um, 20 is the EPS and 7.5 lakhs are the number of shares. So 150 lakh, it becomes the overall earnings, right? So this divided by the total number of shares, right? Just now we calculated above 28.75. This is equal to 6.956 per share. So second part is done, students. Any doubt or any question, students, please do let me know. We'll move ahead. Then what are they asking next? Next, they are asking us to calculate what is the expected market price per share and market cap after acquisition. Now we have calculated EPS. We are given that P ratio is same. Can we calculate the market price? The answer is yes. We can calculate the market price and hence the market cap also. MPS is equal to PE ratio multiplied by EPS, correct? The PE ratio is given to be same, which is 10 into 6.956. This is the EPS and hence this will become 69.56 per share. And hence the market capitalization will become 69.56 per share multiplied by the total number of share, which is 28.75 lakhs. Right? This we've calculated in step 1B. So it becomes 1,999.85 lakhs. Overall market share is equal to, or should we mention overall market cap is equal to 1,999.85 lakhs. right? Then let's come to the next one. Then the next one is calculate the free float market cap. Now, what was the free float market cap, which is other than the promoter's holding, right? That we discussed in the formulas. So, free float market cap is equal to 1 minus promoter's holding, right? So, first of all, combined promoter's holding is actually 60%, and hence the free float percentage will be how much? 40%, right? So the free float market cap will become 40% multiplied by the overall market cap. Eight five lakhs. So this becomes 799.94 lakhs, right? This is the free float market cap. Simple. So this was a very easy and simple question, except for the fact that it has the market capitalization, free float market capitalization as a concept, right? And that we discussed in the previous, like I think in the previous to previous session, where free float market cap means whatever promoter is not holding, right? Whatever the promoter or the promoter group is not holding, that is called as the free float market cap. Now let's come to the next question. Any questions, students? Please do let me know. Any queries? Please do let me know. We'll
Sir,
keep on moving. Yeah.
sir, could you tell the relevance of that free float market cap?
Yeah. See, basically, while we were discussing the concept, also we discussed one good case about the HDFC and Reliance, right? See, ultimately, if you see, free float market cap is an indicative of the fact that how much shares are actually being held outside the promoters group, right? Now, while we were discussing, I'll just go back to that and try to link it. Yeah, see here we were trying to tell the relevance of the free float market cap also. So recently there was an article also in which it was mentioned that, let's say HDFC Bank, I'm just giving this in hypothetical figures. HDFC Bank had 165 million as a market cap, right? And Reliance had a 200 billion. So the chances of Reliance, having a higher impact on Sensex is more, right? Because they have a higher market cap. But what we consider is only the free float market cap, because Reliance 50% of the holding is, let's say, held by the promoter, but HDFC everything is free float because the promoter's holding is very minimal, right? So ultimately, for on a Sensex or an index, the free float market cap will have a higher impact, right? Not the overall market cap, because it denotes that how much flexibility, or let's say how much percentage of the equity can be freely traded in the market. Okay. So question number 19. The following information is related to Fortune India Limited having two divisions, which is Pharma division and Fast Moving Consumer Goods division, FMCG division. Right? This they are calling it as FMCG, and one is the Pharma division. And this is we are talking about one company, Fortune India Limited. paid up share capital of Fortune India Limited is consisting of 3 lakhs equity shares of rupees 1 each. Okay, Fortune India Limited decided to demerge Pharma division as Fortune Pharma with effect from 1/4/2009. Okay, so they are trying to demerge one of the division in a new company. Details of Fortune India Limited as at 31st of March 2009 and of Fortune Pharma Limited as on 1st of April 2009 are given as below. So now what they have done, so for Fortune Pharma they have given it as on 1/4/2009 and this they have given as 31st of March 2009, right? This is for Fortune India Limited. Okay, then so this is after demerger. I can say that this is after demerger and this is before demerger. Okay, so we can just keep in mind. So there are secured loans, there are unsecured loans, current liabilities, fixed assets, investments, current assets, loans and advances, and deferred tax miscellaneous expenses is also what they are carrying. Now, board of directors of the company have decided to issue necessary equity shares of Fortune Pharma Limited of rupee 1 each without any consideration to the shareholders of Fortune India Limited. Now, can anyone tell me why there is a need to do this? We discussed this in the concepts earlier. Can anyone tell me why there is a need for the board of directors to issue shares to the original company? Now, okay, let me just put it down here. So, we are talking about this business of Fortune India Limited. Fortune India Limited, and they are having two major business lines. One, there is an FMCG business, and second, there is a pharma business, right? Now, this one, now this company they are making as Fortune Pharma Limited, and this company will be deemed as Fortune India Limited. Okay. Now, with this new company coming into place, there are original shareholders of this company, right? So the shares of these companies are going to be issued to the shareholders as well. Now, can anyone tell me why there is a need to do so? Why there is a need to issue the shares to the existing shareholders for the new company? Come on, students.
Holding company.
No. See, it can be a holding company or it cannot be. See, that depends on how do they both of them structure it. But it can be a separate company also compared to the holding company. So the real reason why they are actually
So
issuing the
maybe
shares
to
to,
maintain the control, ownership structure.
yes, that is okay. Correct. So I think Ankita has also answered because they've invested in the whole business. See, ultimately, if I may tell you that this FMCG business is having a valuation of 1,000 crore and pharma business is having a valuation of 200 crore, right? So ultimately, as of now, they hold 1,200 crore worth of investments, right? Now, if we are going to split it up, they will left. So this Fortune India Limited will only left with 1,000 crores, right, as the valuation. So to compensate this 200 crore loss to the shareholders, Fortune Pharma, the new company to which the business is transferred, will also issue shares to the shareholders, right? So this is to compensate them for the loss in the value of the share, right? Because the moment you demerge, some of the value will get transferred to the new company, right? So that is why it has been the case. Okay. Now, what is the question asking us to do? For that purpose, the following points are to be considered: transfer liabilities and assets at book value, estimated profits for the year. The next year they are talking about is this much, and Fortune Pharma is this much, estimated market price is this much. This is for Fortune Pharma, the new company. Average PE ratio of the FMCG sector is 42 and pharma sector is 25, which is expected to be for both the companies. Now, one, calculate the ratio in which the shares of Fortune Pharma are to be issued to the shareholders of the Fortune India Limited. So, this is the first question that will come to anybody's mind, that what will be the correct ratio. Sorry. Second is the expected market price of the Fortune India, the sorry, the remaining company. Then the book value per share of the both the companies after immediately after the demerger. Okay. So let's start, students. I think the first, let's start again with the step-by-step calculation. See, the first one is, now if we see for Fortune India Limited, okay. So let's start with the solution here. Okay. Market price per share is 24.5, right? So this I'm talking about the, because whatever is given Fortune Pharma here, right? So the market price is 24.50, and then the PE ratio is also given as 25. This is for the pharma sector. So for the pharma sector, we have taken the PE ratio, and for the Fortune Pharma, we have taken the MPS. So the EPS can be calculated using this earnings per share, right? Which is 24.50 divided by 25. This becomes 0.98 per share, right? And the profits for Fortune Pharma was how much? For the next year, it was given, right? These were 11,400 for Fortune India and 1470 for Fortune Pharma. So 1470 lakhs is for the Fortune Pharma. So hence the number of shares can be calculated by taking the total profits divided by the EPS. The answer is yes. 1470 lakhs divided by 0.98 per share. So this becomes 1500 lakhs. So the number of shares that currently the new company have is 1500 shares. 1500 lakh shares, right? And what are the existing number of shares for Fortune India Limited? 3000 lakhs, right? So here they have 3000 lakhs. Okay. Now, if Fortune India had 3000 lakhs and Fortune Pharma is ended up having 1500 lakhs, so what is the ratio? The ratio would have been 0.5 is to 1, right? For every one share in Fortune India Limited, Fortune Pharma would have issued zero point 0.5 shares, right? See, in this, we have calculated the swap ratio from a back calculation model, right? It's not that we have arrived at the swap ratio through some methodology. The reason is because the question has not specified that how the swap ratio will be calculated, right? The question simply says that these are the numbers, and whatever are the missing pieces that we have find it out through EPS and hence through the profits, the number of shares and what is the overall number of shares for both the companies, right? Hence the ratio is 0.5 shares of Fortune Pharma for one share of Fortune India. The next part is expected market price of Fortune India FMCG Limited. So the one that is continuing company, I mean the original company, for that what is the expected market price? See, for that we will make use of the PE ratio and the EPS, right? So expected market price of Fortune India FMCG 1 is, see, first of all, what is the estimated profits for the next year? 11,400, right? And divided by the number of shares, which is 3,000, the EPS becomes 3.8 per share. The estimated PE ratio, right, is 42. MPS will become 3.8 into 42, 159.60 per share. I think as easy and simple without any complications. Okay. Now the third part is asking us to calculate book values per share of both the companies immediately after demerger. Now, if you see, one has been given after demerger only, which is Fortune Pharma. But for Fortune India, after demerger, we have to calculate, right? Because that is something that is not given in the question. So let's calculate that and then we will arrive at the book value. So let me put it here. Third, book value. So let's say before demerger Fortune India, we have to make three columns. Fortune India before demerger, then Fortune Pharma after demerger, Fortune India after demerger. Okay. Now, what was the asset size all put together? If we see fixed assets, investments, current assets, loans and advances, and these all put together is 70,000 lakhs. This one is 25,100 lakhs. So the difference between both of them attributes to the after demerger Fortune India Limited, which is how much? 44,900 lakhs. Then on the liabilities, 25,000 lakhs, 4,100 lakhs, and then 20,900 lakhs. Okay, so the net book value. So this column is actually the difference of A minus B. Okay, that's all simple. So here, sorry, we have to first calculate the net book value as a subtraction of liabilities and assets. That is coming out to be 45,000 L, and this is 21,000 lakhs, and this is 24,000 lakhs. Then finally, number of shares. Here we have 3,000 lakhs, here we have 1,500 lakhs, and here also we have 3,000 lakhs. Why? Because this is the same company, na? That's why. Yeah. Then we'll just divide it, book value per share. 45,000 divided by 3,000, right? Then 21,000 divided by 1,500 is 14, and this is 8. Clear, students? Okay. Should we move ahead? Is there any other query or anything? Please do let me know. Otherwise, we'll move to question number 20th. Question number 28. During the audit of weak bank W, RBI has suggested that the bank should either merge with another bank or may close down. Strong Bank has submitted a proposal of merger of weak bank with itself. The relevant information and the balance sheet of both the companies are as under: the weak bank, strong bank, and what are the other matrices that have been given. So gross NPA, capital adequacy ratio, total capital divided by the risk weighted assets. They have given the definition of this capital adequacy ratio. Okay. Then market price per share and book value. Trading on the stock exchange, weak bank is irregular and strong bank is frequent. And they have given us the weights also. What weights they have given for the respective KPIs. Then balance sheet is also given. Finally, they are asking us to calculate the swap ratio based on the above weights. That is fine. Ascertain the number of shares to be issued to weak bank. Prepare balance sheet after merger and calculate CAR and gross NP of the strong bank after the merger. Now, can anyone tell me there is the catch in this NP ratio that I've told in the at the time of formula, right? While we were discussing the formulas and concepts, I discussed about the NP related swap ratio. Let's see while solving this how we can utilize that. So solution. So first of all, you have to calculate the swap ratio, right? So swap ratio can be calculated basis all these four factors, right? The first one is so A is basis gross NPA, right? So gross NPA, it is weak bank divided by strong bank or vice versa. Should I do this? Because always we are taking target company in the numerator and acquiring company in denominator, right? So is this the right thing to do for gross NPAs also? For NPAs kind of a matrix also? Come on, students, tell me. Correct. So Ankita is saying no. Then the right method was what? As we discussed, it should be the acquiring company in numerator and the target company in denominator. And we discussed about the logic also, right? So this is wrong. The correct version is 5 by 40, right? Now the second one is the capital adequacy ratio. So this, since this is a good, let's say, ratio, just to remember, it should be weak bank divided by the strong bank, which is 5 by 16. Then market price per share, again weak bank divided by strong bank, 12 by 96. Book value per share. So first we need to calculate the book value, because in the question balance sheet has been given, right? This is weak bank. This is strong bank. Paid up share capital is already given 150 and 500. If we see this one, right? So that we will take as is. Then reserve and surplus we will adjust for it. Yes. Which is 80 and 5,500. Then this preliminary expenses we will reduce. Right? Because preliminary expenses are not part of the book value. That's why. So this becomes 180 and this becomes 6,000. This is the total book value. And this we can divide it by the number of shares that is also given. So this is 15 and 50, right? So the how we have derived these number of shares, because we have rupees 10 per paid up share capital, right? So 150 divided by 10 and 500 also divided by the 10. Then book value per share comes out to be 12 and 120, right? So this is again 180 divided by 15 and this is 6,000 divided by 50, right? So 12 and 120, so it will become 12 divided by 120. Simple. Weak bank divided by the strong bank. Then ultimately we have to calculate the overall swap ratio. Calculation of overall swap ratio by assigning the weights to the respective part, right? So the first one is ratio, weights and weighted ratio. Gross NPA 5 is to 40, 30%, right? Then second one is capital adequacy ratio 5 is to 16. This was 28%. Market price per share, the ratio is 12 is to 96 and here it is 32%. And then book value per share was 12 divided by 120, for which the ratio is 10. So the weight is 10%. And now the weights multiplied in the ratio we calculate, it becomes 0.0375, 0.0875, 0.04, 0.01. So 0.1750 is to 1. This has become the overall swap ratio. Okay. Then the next part, so the swap ratio is done. Ascertain the number of shares to be issued, right? So this is nothing but the swap ratio multiplied by the existing number of shares of weak bank, right? Number of shares to be issued by strong bank to the shareholder of weak bank, right? So 150 divided by 10 are the number of shares for weak bank multiplied by the swap ratio, which is calculated in the above calculation. So this becomes 2.625 lakh shares. Now, ultimately, what will happen? The assets and liabilities of the weak bank will get shifted to the strong, and strong bank will issue further shares of 2.625 lakhs, right? From their own balance sheet, correct? Now, the third part is prepare balance sheet after merger, calculate CR and gross NPA. So let's do the balance sheet, right? Now for doing the balance sheet, first of all, we have the strong bank balance sheet, which is this one, right? In this, we will keep on adding the weak bank respective assets and liabilities, except for the fact that for reserves and surplus and paid up share capital, we will just take the number of shares that we are issuing. So let's first see that what is the difference between both of them that might come out, right? So here if we see, we have 180 as the net book value that we are taking over, right, for weak bank. So and for taking over 180 net book value, we are issuing 2.625 number of shares, right? Lakhs number of shares. So let's first calculate any goodwill or capital reserve, let's say, which is the differential amount between the amount that we pay and the value that we receive, right? So book value of weak bank was 180 that we have calculated, right? Minus issuance of shares. So 2.625 lakhs will be issued at the rate of 10, which means that 26.25 lakhs will get issued, right? So ultimately, we have got something which has a value of 180, but the amount that we have paid is equivalent to 26.25. That means we have a overall amount that is gain, right? Which is capital reserve. Right now, let's do the balance sheet part. So this is going to be the strong bank and rupees in lakhs. Okay, let's take the particulars and we will take the same format and the sequence how it is given in the question. So paid up share capital 500 were the original one plus 26.25 is the fresh issued. So it becomes 526.25. Then paid up share, sorry, the reserves and surplus, the amount will remain same, which is 5500 students. Because reserves and surplus, nothing gets added, right? Because these are for the company that they have accumulated. It's not a liability or an asset, right? So this is 5500. Then capital reserve will come, the one that we have just now calculated, right? So that was how much? Sorry, 153.75. Then deposits coming as liabilities, which is 48,000, the total of 2. Other liabilities, again, the total of 2, 3390, and hence the total becomes 57,570. Okay. Then for assets, cash in hand slash with RBI. was 400 plus 2500. So this becomes 2900. Balance with other banks. It is 2000, which is again 0 plus 2000. Then investments 1100 plus 19,000, 20,100. Then advances 3,500 plus 27,000. So this is 30,500. Then other assets 70 plus 2,000. So 2,070. And finally total assets 57,570. Again the same number matches to the liability. Clear, students? So in terms of the entire balance sheet, we have just added horizontally the assets and liabilities only with the fact that share capital has been added at the face value, and the difference that we have already calculated as capital reserve has been shown as part of the capital reserve. Now the last part is asking us to calculate the post merger values of CAR. Calculation of CAR after merger. Now, CAR is given as, that was also part of the question. So, capital adequacy ratio is equal to the total capital employed divided by risk weighted assets. Right? This is what the formula is. Now, if we individually have the risk weighted assets, then we can calculate the total risk weighted assets and hence the overall capital adequacy ratio. Now this is weak bank, this is strong bank, and this is the merged bank. The 5% was given for this. For strong, it was given as 16%, and merge is what we have to calculate. So the total capital is 180 here and 6,000 here, right? So this is the total capital, capital plus reserve and surplus. The risk weighted assets can be calculated by just taking this formula, right? 180 divided by 5%, and here it will be 6,000 divided by 16%, right? So here it will become 37,500, and here it will become 3,600, right? This is the risk weighted assets. How we have calculated using the percentage 5% and 16%, and since we already know that what is the total capital, we have just arrived at the risk weighted assets. So the total we can take it now. Yes, the answer is 41,100 is the total. So the capital adequacy ratio for combined entity will become how much? Now we have to first of all take the total capital, right? Total capital is can be taken from the new balance sheet. This one plus this, right? All these three values up to capital reserve we will have to take. So which is 526.25 plus 5500 plus 153.75 whole divided by 41,100. 15.04 percentage students. Okay. So this becomes the capital adequacy ratio for the combined entity. I hope this is clear, students. Is there any other doubt? Please do let me know. Okay. The last, the last part, second sub part is calculation of the gross NPA percentage. Gross NPA percentage. This is after merger. Okay. Now again for weak bank, for strong bank, and finally for the merged bank. Okay. So the gross NPA percentage is 0.40 and 0.05, right? Which is the numbers that are already given, 40% and 5%. And merge is what we will have to calculate. Now, how it is calculated? What is the NPA? NPA is a non-performing asset. So how much of your loans and advances that you have given are categorized as NPA is what this percentage denotes. So let's first put the overall advances numbers, right? What are the advances? For weak bank it is 3500, for strong bank it is 27,000, and hence the overall number it is 30,500, right? And then GNPA, which is this percentage, right? If we apply on this advances, it will become the absolute amount of non-performing assets, right? So which is effectively 3500 into 0.40, which is 1400, right? And here it will be 27,000 into 0.05, which will become 1350, and hence the total becomes 2750. So 1400 plus 1350 is the total amount of the gross NPA. Now, gross NPA percentage for the overall can be calculated as 2750 divided by 30,500 into 100. Simple. So the overall gross NPA becomes 9.01 percentage of the merged bank. Clear, students? So with this, the mergers and acquisitions, the questions are completed, right? And now we will start with some of the discussions on the other concepts under mergers and acquisitions. Again, students, if there is any doubt, please do let us know. So let's first of all start with the rationale for mergers and acquisitions. So some of these topic students, we are taking it from the study material, right? For mergers and acquisitions. Now, come on, students, tell me. I want first all of you to please answer. According to all of you, what could be the possible rationale? Rationale means what is the objective for doing a mergers or acquisition. We can make it more interactive. Then I will structure this basis all your responses, and then we will finally conclude. Okay. So, come on, students, tell me what can be the possible rationale for mergers and acquisitions basis all the discussions that we did till now. You can mention your answers or
To
speak
increase
out whichever
market
way.
share.
Sorry, to increase.
Market share.
Very good. Increase market shares. Apart from this, for what all rational we will do M&A?
Achieving greater profitability with the help of synergy benefits, which are there
Very
others entities like profitable management strategies or
correct. So synergy benefits is the other key point. Then to save the company and employment which is in loss. Okay. So basically the company incurring losses. Okay. Anyone else? So synergy we have taken, company incurring losses, increasing market share. Any other reason you guys feel should be the reason for this?
to
Any
decrease
other
the
thought that comes to mind? Yeah.
decrease number of
Sorry, to
competitors.
decrease. Yeah, to decrease number of competitors or to increase the market share. Let's say it's one and the same thing, right? If you're increasing the market share, we're decreasing the competitor. But yeah, I think good attempt. Anything else anyone wants to add? Okay, so let's put all these points into the different structures, right? So the first one is synergy. I think this is well discussed in some of the questions, and all of you are aware what is synergy. Synergy is value of A plus B combined entity is higher than value of A plus value of B, which is the old companies, right? So if we individually add the values of different companies, it is always lesser than the combined entity's value. And the reason is because once the companies get merged, so there is a lot of things that comes into the play. For example, economies of scale. For example, any sort of overheads reduction. Now you don't need the same level of management that you were needing in both the companies. So the same management can oversee both the companies, right? Same board of directors. So all these costs helps in reducing the, let's say, I mean, all these factors helps in reducing the cost, which in turn helps in the overall driving value of the combined entity to be higher than the individual summations, right? There can be some operational benefits also, right? So synergy is the first rationale. Then the second rationale is diversification. Now let me link you back to your portfolio management. In your portfolio management, what have you discussed about the diversification of unsystematic risk? Okay, first help us tell me, can systematic risk be reduced? Can we reduce the systematic risk? Please answer my question.
yes.
Okay, one answer is received a yes. What about others? See, in that we have studied, right? Risk comprises of two elements, systematic and unsystematic. Don't get worried. Once you will revise, you will remember. Okay. So we discussed about two things, right? One is systematic and second one is unsystematic. Systematic is because of the system. It's because of the environment. It's because of the macro factors. Unsystematic is specific to that company, specific to that company, which is a micro related factor. So systematic risk is there for all the companies and it cannot be reduced. For unsystematic risk, it is specific to a company and it can be reduced if we invest in another uh, company which has a negative relationship, right? The negative correlation coefficient, covariance, remember? So all those things are there. So diversification means reduction of risk, but ultimately we will be able to reduce the unsystematic risk, right? Because the systematic risk will still remain. So let's take an example here. So let's say there are two different sectors. One is FMCG and second one is real estate, right? These are the two different companies. Now, FMCG company will again have its own, let's say, historical trend, or it has its own outlook in terms of how future will come. Similarly for real estate. But if we kind of merge these two, so or let's say both of them operate under one group, so that is called as diversification because you're diversifying. You are putting different businesses into your verticals. Then the third rationale is taxation, students. Have you ever w- wondered that for a weak company there will be accumulated losses, and these accumulated losses are both in the books as well as in the tax books. If these are there, then these give rise to unadjusted brought forward tax losses, which if strong company takes over. So let's say strong company is taking over the weak company, right? It will also take over the accumulated losses and it can set off against the future profits. Clear, students? Yes, I think Stephen has mentioned about the tax savings. Very good, Stephen. I so so this ultimately will be dependent on the different laws that are there in the tax laws, right? What all conditions needs to be fulfilled before this is allowed. But still, this is one of the rationale. Then the fourth rationale is about growth. Now, students, let me tell you, there are, let's say, two companies, A Limited and B Limited. Both of them operate in the same segment, let's say in the same business vertical, right? So let's say in year one, A Limited reported a sale of 1,000 crore. So let's say in the next year, with a growth at the rate of 10%, the company can reach to 1,100 crore, right? This is year two. This is a normal growth. This is a normal growth. Now, if you talk about B Limited, here the revenue is 600 crore, right? Now, for achieving growth, A Limited has two options to continue what it is doing, which is the normal growth. Or second is to acquire B Limited and achieve disproportionate growth of 600 crore, right? So this 1,000 crore in year one will become 1,700 crore in year two. So which is contributed by 100 crore and 600 crore. So this is post acquisition. We're talking about post acquisition. So this is called as organic growth. Organic growth means whatever has been the existing trend. Sorry, whatever has been the existing trend, which is 10%. And second one is the inorganic growth. Okay. The second one is inorganic growth. So this acquisition has led to the inorganic growth of 600 crore. Now, if you see ultimately in the financials, the big proportionate increase will be seen, and hence some of the companies want to resort to the higher growth numbers, and hence they report these. Clear? The fifth part is consolidation of production capacities and increasing market power. I think this is something that all of us discussed, right? One answer also came that if we want to increase the market share, this is that point. Okay. Now let's say A Limited is having a market share of 60% and B Limited is having a market share of 10%. If they both of them gets combined, they will have a 70% of the market share, and 30% is, let's say, held by 1,000 different brand owners, which is highly disintegrated. So ultimately you will emerge as the single most player in the market. Clear? So these are some of the rationales for doing a mergers or acquisition, right? Practically for which the companies resort to synergy, diversification, taxation, growth, and consolidation of production capacities and increasing market power. Clear? Let's move ahead, students. Any other doubt, any other thought? Okay. Then let's come to different types and forms of merger. So first one is horizontal merger. So horizontal merger means, like, horizontal is a line, right? Like this line. This is called as horizontal line. Now this is happening, let's say, between A Limited and B Limited. Both of them belongs to the same industry. Can anyone tell me what do we mean by industry? What do we mean by industry? See, industry is actually collection of companies. It's not a single company, first of all, it's a collection of companies. Collection of companies having common set of consumers with a common need. Yeah, very good. So Ankita has, yes, Ankita has given an example. Textile industry, automobile industry. Yes, you're right. Origini, you are also right. Collection of companies having same products. Very good. So these are all the, I mean, for example, textile, automobile, FMCG, pharma. These are all the industries in which, let's say, 10, 20, 30, 40, whatever are the number of companies they operate. Okay. So if let's say two companies from the same industry gets merged or gets into M&A, that is called as horizontal merger. Okay. Horizontal means because they are at the same standing, they are at the same industry. That's why. Vertical merger. Now, if you see vertical, how do we draw vertical? Like this, right? These are the vertical lines. Now, let's say A Limited is here and there is a vendor called B Limited which supplies to A Limited, and A Limited has a customer as C Limited to whom A Limited supplies. This is the customer. Okay. So you see, this is the value chain, right? A Limited is a company which procures from B Limited and sells to C Limited, right? So if let's say A Limited and B Limited decides to merge themselves, that is called as vertical merger. Or even C Limited and E Limited decides to merge themselves, that is called as a vertical merger. This is called as forward integration. This is called as backward integration. And both of them put together are called as vertical merger because the companies are getting merged vertically. So they have a buyer seller relationship. They have a buyer seller relationship. So horizontal merger done, vertical merger done. Then let's come to the conglomerate merger. Okay. Now conglomerate merger is where the diversification is happening from different industries which are unrelated. A Limited unrelated to B Limited in terms of the nature of business. Unrelated means nature of business. If the nature of business is unrelated and they are getting into merger and acquisition, then it is called as a conglomerate merger. Co-generic merger. So students, co-generic means that they have the same genre, right? So they have the same, let's say, some common linking point. For example, A Limited, B Limited, they are either from the same industry or some factors are common. Which are they? For example, technology. They use some common platform, right? Or they have some common distribution channel through which they supply their products. Distribution channel. We'll come to one of the example also. Or third is product line is similar. So let's say if these two, three things are there, or any one of them is there, then it is called as a co-generic merger. Now let's take an example. Let's say A Limited is an NBFC and this is also a NBFC. It has a business of giving auto loans and it has a business of giving credit cards, right? Both of them are to the separate consumers, right? So the consumers are different because one who need credit card will be different from one who need auto loan, right? But can I say that they belong to the same industry? The answer is yes. They belong to the same industry of giving loans. Sorry. And the channel through which they access the consumers or the customers is through agents, so which is same. So distribution channel, sorry, through agents, this is the same. And then finally, product line is again similar, right? So if these two companies merge, then it is called as co-generic merger. Then there is a different type called reverse merger. Okay. So in this reverse merger, what happens? See, generally a large company takes over small company, right? But here what happens? A private company takes over the public company, and this public company gets merged into the private company, helping this private company to go public. You're getting my point? So they merge so that the private company goes public, but the private company is actually acquiring the public company. Please remember. Okay. Yes, Ankita, you are right about the previous example. Okay, so this private company, once it acquires the public company, so this is called as a reverse merger because the public company gets merged into the private company, and as a whole, the combined entity goes public, right? By goes public means they are collectively regarded as the public company. So, in a way, private limited company has achieved the objective of going into the public without issuing, let's say, the prospectus, without going to the time consuming process or other things. Okay. Then on acquisitions. So in acquisition, what you do, you purchase the majority stake or you establish a control board of directors. The moment you do this, you are treated to have a control in place, and hence you are having a acquisition running, right? So these are the different forms of merger. Just a second. Yeah, and these acquisitions can happen through an agreement, through shares purchase, through outright purchase, or through just an agreement wherein they are given a right to control the board of directors. Okay. So yeah, I mean this was it as of now. So there are some other pointers on the mergers and acquisitions also related to divestiture. So let's do one thing. Let's break for 10 minutes and then we will cover the balance part, students. Okay. So we will again reconvene at 8:35. Okay. question wherein Ankita was asking about some of the examples for, I think, for reverse merger. Okay. So I think so. See, one of the example which I can recall is ICICI Group getting merged with their subsidiary ICICI Bank. So ICICI Bank was a subsidiary of the ICICI Group, right? So the entire group got merged into the ICICI Bank, one of the subsidiary, to create a bank, right? So basically, see, the test to establish whether it is a reverse merger or not is what? The acquiring company is having lower amount of value of the assets compared to the target company's value of the assets. If that is established, then it is a reverse merger. Okay. Okay. Now we were talking about Divestiture. Let's start discussing on the topic of Divestiture. So Divestiture is actually Divestiture. I think the spelling. Let me write in a D. Why it's not coming? Yeah. Okay. So divestiture means selling. Okay. Selling of what? Selling the assets. Selling or disposing of, baby. Selling assets or group of assets or business units, right? Something of these sorts. If we do, these are called as divestitures, right? There are different forms of divestiture again. So first one is sell off or partial sell off. Here, what do? You just do a slump sale of the business. Okay, you do here slump sale of the business. Or let's say you sell one division of the business to an outsider. You partially sell some of the plants, right? Let's say you have 5 or 6 operating plants. You sell one of the plant, that is called as a sell off or partial sell off. Okay. The second one is spin off. So in spin off, what you do? So let's say there is a company which has two business divisions, business one and business two. So business one continues in A Limited, but business two is actually taken to a new company called B Limited, right? So this is called as spin off. Any example? Today only we did one, right? Fortune India and Fortune Pharma. Correct, students? Remember? So Fortune Pharma gets pinned off from the Fortune India. And this is for which division? The pharma division, students. Okay. Then the next one is actually split up. Okay. So in split up, there is a company A which splits into many companies. It gets split into different companies, and as a result, A is dissolved. It is dissolved, students. Okay, so one, the company gets dissolved, and second, it gets splitted up into the multiple different companies. Okay, then the fourth one is equity carve out. So equity carve out is typically this spin off as well as the issue of new equity shares also in the market. So if two things happens, so equity carve out means that we are carving out a business and also we are having a new equity in place. So spin off plus issue of new equity shares in the market. This collectively is called as equity carve out. Clear, students? Yeah. So these are called as equity carve out. Now, in the case of Fortune India and Fortune Pharma, the carve out has the carve out was there, but there was no new issue of equity shares. All the equity shares of 1500 lakhs were issued to the existing shareholders of Fortune India Limited, right? If we remember as per the solution. And the last one is actually demerger slash division of family managed business, right? So let's say we have seen typically wherein a family managed business gets split up. So that is where the demerger or division happens, right? So there is a small topic of this financial restructuring also. So typically financial restructuring means that you are restructuring your capital because you are a sick company, right? If let's say there is a sick company which has huge amount of accumulated losses, right? Accumulated losses are huge. The borrowings are sitting in the balance sheet against which there is no repayment possible, right? So these are called as negative net worth companies, wherein the net worth becomes negative, right? So for that, we will have to carve out a plan to revive, right? How will you revive them? See, that is the entire process is called as the restructuring. Now, financial restructuring, one is, let's say, the equity share capital will have to be reduced, right? Earlier, let's say it was 10 rupees paid up. Now it will become 5 rupees paid up. Balance 5 will be used to write off some of the amounts. Then, similarly, about the loans and borrowings, right? About the loans and borrowings. So, if let's say 10% was earlier the rate of interest, now it will become 9%, and some of them will become convertible loans, right? So some of them will be convertible into equity so that the amount has not to be repaid back in terms of the cash flows. Then lastly, let's say the working capital, some of the changes will come. Let's say we'll ask creditors for more credit. We'll ask debtors to give us money on time. So all these things, all these measures are called as the financial restructuring measures. Right? Now, if you see the way we can restructure the ownership restructuring can happen into many ways. The first way is going private. See, all of you would have heard about this going public, right? Where you will issue shares to the public. But going private means that you are already a public company, but you are buying back your own shares from market to become private company, right? This also happens. So this is going private because you don't want to lose your control. You want to again get back the control on the business, and hence you want to become a private company again. Then management buyout. In this, management itself purchases the company. Let's say there is a management is separate from the ownership, right? That's what we have understood. But in this case, management will themselves take over the company. Then leverage buyout. These are called as LBOs. Leverage buyout means there is a merger and acquisition happening, but for discharging the purchase consideration, the person takes a borrowing. So let's say borrowing is taken, borrowing taken, and then purchase consideration is discharged, right? And then lastly, there is a equity buyback. right? Which is similar to what we have discussed above. So in case, let's say there is a equity buyback that happens, that will be deemed to be an ownership restructuring. Then there is another topic called as special purpose acquisition company. So this is an important one. This is a new topic, special purpose acquisition company. See, these are called as SPACs, right? SPAC. What is the purpose of them? See, they will raise the money, keep it for some time they have a deal in place. The moment they will have a deal or a, let's say, an investment opportunity, they will quickly invest that amount and start getting the returns. So in this, what happens? There is an IPO first of all, which is initial public offer. Okay. Once the IPO is done, then they actually end up raising the funds from public at large. Once the funds are raised, then this SPAC company, the one that is formed, it either creates a trust or it is in the form, it keeps money in the form of trust or escrow account. Whatever the amount has been received, it keeps in there after launching the IPO. Okay, and the proceeds from IPO are kept here. Let's say they are kept for 2 to 3 years till the time 2 to 3 years till the time the acquisition of a target company is crystallized, or let's say a decision to acquire a target company is taken. Till the time it is kept there, acquire a target company. The moment you finalize the target company, you go back to the shareholders, ask their approval, and go ahead with the deal. Before finalizing the deal, approval from majority stakeholder is required. Then, till the deal is finalized, the money is kept in an escrow account or a trust. Okay, then lastly, there is a proper due diligence that happens before any call is taken for the acquisition. So this is the entire objective behind raising funds through a SPAC, special purpose acquisition companies, right? So yeah, and these are called as blank check companies because the amounts that are given to SPACs are in the form of a blank check, right? Whatever name will be put for the target company later on can be put, and the deal can be approved by shareholders. That's why these are called as the blank check companies. Sorry. Okay, students. I hope This is clear till now. So this was it on the mergers and acquisitions. Now let us move to the startup finance, students. Okay. Now on the startup finance, this is the new topic different from mergers and acquisitions. Okay. First of all, startup finance. Sorry. Yes. So startup finance is a different topic. Okay. So let's discuss on this. So, startup finance, first of all, let's understand what is a startup. What is the meaning of startup? I'm referring to again the study material. Okay. So, the concepts that we will be discussing is strictly from the study material. Now, there is a there are certain conditions to be fulfilled for a company to be qualified as a startup. The first one is it has to be a private limited company or registered partnership firm or limited liability partnership. So these are the legal forms of startup. See, it cannot be a public company. It can neither be a sole proprietorship, right? So all these things are not allowed. So only these three forms are allowed. So the things that we are going to discuss now are actually notified by the central government. So if these conditions are satisfied, then only a business can become a startup. Okay. And the second is it should be within the first 10 years of its operation. Okay. So first 10 years of incorporation should not get lapse. Okay. So we're talking about the first 10 years of operations. And then the turnover should be up to 100 crore. Turnover up to 100 crore, not beyond that. Okay. So turnover should be up to 100 crore. If it crosses 100 crore, then you are become a big company. You are not a startup then. If you are in the 11th year of your after incorporation, then also you are not a startup. It should not be formed through a split up or reconstruction of any existing business. Okay, because existing business is already there. It will not be regarded as a startup if you are starting something of that existing business. Let's say Fortune India and Fortune Pharma, the case that we discussed, right? So Fortune Pharma gets incorporated as a new company on 1st of April 2009, but you cannot regard that as a startup. Okay, because that was a split up or reconstruction of your existing business, students. That's yeah. Okay, then apart from this, it also tells you that the objective of this entity should be working towards innovation So it should be engaged in some of these activities, right? It should innovate, it should develop or improve the products or processes. Develop or improve products, processes, services. If these three things are developed or produced, or if it is a scalable with a high potential of employment generation, it should be scalable, and there should be a wealth generation motivate motive or employment generation motivative, right? So these all things should be there, and the technology should be core, right? So if let's say the new ventures that they are starting up is not serving any, or let's say is not innovating, is not improving the existing policy, the existing processes, products or services, and it's not scalable also, then it will not be regarded as a startup. Okay, so it has to have some element of, let's say, technology, right? In the form of innovation, in the form of deployment, in the form of provision of service, right? So yeah, so if these things are there, if these five pointers are there, then that business will be regarded as a startup. This is as per the definition of the notification that got released. Okay, clear, students? Any question or any thought that you want to share till now? Okay, so then let's move ahead. So now this is a topic on startup finance, right? First we understood what is a startup. Now what are the different ways to do the financing of a startup? Because see, ultimately startup is a very new phenomena, right? By the sense that the business gets, established newly, it is facing a lot of issues in terms of how the funds will be available, how the funding will be done, right? Because that is the major roadblock for a startup, that from where they can arrange the funds. So the entire discussion going ahead in this topic, we will discuss about majoritarily on different ways of financing that are available to do a startup funding. Okay, so the first topic is innovative ways to finance a startup. To finance a startup, what are they? See, first of all, there is a way to finance that is called as personal financing. Okay. See, personal financing means that whatever personal capital that the founder is having. See, first of all, who is a founder? Okay, come on, tell me, students, who is a founder of a startup? Yes, tell me, students, who is a founder of a startup?
Promoter holding that we saw.
Correct. Or let's say the person who has that idea, right? Who has that. So promoter is, yes, promoter is the founder only, but the person who has that idea, who brings all the resources together, who would want to make live those ideas, so that person are called as founder, and they will create the foundation of that startup. So if they have their own personal, accumulated capital, they will use that as a amount for the financing of a startup. That is one. Second is personal credit lines. So these credit lines are nothing but the credit cards. Let's say these personal credit cards, because it is So they can use their personal credit cards in a way to finance the requirements of a startup also, right? Then friends and family. So friends and family can give them, or let's say invest behind the idea that their that their friend, family member or friend is actually pitching that idea to them, and they can either lend money or invest in behind their ideas as a ways to finance a startup, right? So this is again the internal ways, how we can finance. Then peer to peer lending. So peer-to-peer lending, what happens in this, that one founder is actually giving the loans, or let's say borrowing from the another founder. Let's say there is a group or there is a network wherein all these people are together, so they will do the peer-to-peer lending, right? They can do the peer-to-peer lending as one of the innovative ways to finance the startup. So personal financing, that means their own funds. Personal credit lines means whatever personally they have been issued the credit cards that they can use it. Friends and families, again, whatever informal sources of funding that they have apart from the bank, wherein these guys trust the founder behind their ideas, they can also invest or they can also give amount on the loan. Then peer-to-peer lending means the similar founders of the other startups can also lend to the other people. Then there is a term called crowdfunding. Now, can anyone tell me what do you mean by crowdfunding? Is anybody having idea what is the meaning of crowdfunding? Yeah, students, come on, tell me. What is meant by crowdfunding, students? In case any one of you have any idea. See, okay, let me explain. Let's break this into two parts, crowdfunding, right? One is crowd and second is funding. So what is happening, see, there is a platform. By platform we mean, let's say, a website or an application, right? This is a platform. This, I'm writing it as ecom platform. See, on this there is a lot of traffic that is coming, which is in the form of crowd. Okay, so let's say people like you and us are registered on this platform, ecom platform, right? So we are, let's say, thousands of individual investors who are registered on this platform. Okay, and we have funds. And while we talk about these funds, these are not in crores, right? These can be in the smaller ticket size also. It can be in thousands. It can be in lakhs. That depends on whatever we want to invest, right? It can be in the smaller denomination. It can be in hundreds, right? So here on this part, there are all these people who are having smaller amount of funds, smaller ticket size of funds, but they are huge in number. That is why they are called as crowd. They are registered on this ecom platform. Similarly, there are these startups that are also registered under this, let's say, case. I mean, uh, there are different companies that are registered here, right? Okay, there are these different companies that are registered over here as well. Okay, and these are actually in the need of the funds, right? These companies need funds. So what I can do, if I'm registered here as a investor, I can just go and see which company I want to invest and what amount I want to invest. That amount I can give as a investment to that company. and hence this is called as crowdfunding, because a lot of people, and this keeps a proper record, right, that who has invested where, what are the cases behind those investing, whether what is the value of those investments, when are the repayments due of those investments. So all those things are managed through this ecosystem, right? But the idea here is that no one is investing a bigger amount, they are just investing a smaller disintegrated amounts. That is why it is called as crowd funding, students. Okay, any other doubt, students, in this? Okay, so let's move ahead. Then comes micro loans. So these micro loans are the smaller loans that are available from the bank or the financial institutions who are willing to lend to a startup, right? So this is for the, let's say, smaller amounts, smaller tenure, right? Smaller ticket size. So this is for the startups. Again, a normal way to lend and invest. Then another one is vendor financing. See, vendor financing is basically wherein you are asking your vendors to give you higher amount of credit period. Let's say instead of 30 days, you're asking them to give you 45 days. That will help you, right, to drive your another 15 days of credit. Correct? So that is one of the internal ways how you can actually do the financing for a startup, right? Then the next one is purchase order financing. See, purchase order financing is basically once, let's say, a person gets a purchase order, the same person also receives money from the person who has given the purchase order to start activities on the fulfillment of this purchase order. Okay, so generally it is an advance given to the supplier for the purchase orders issued, right? That is called as purchase order financing. Then the next one is factoring accounts receivable. Does anyone have any idea what is this? This is an easier one, right? All of you would have studied in your inter also. What is
Like
factoring?
we discount the bills with the banks, factoring in that case companies discount their receivables with the companies which can give them financing, charging
Right,
the
very
financing.
good. Correct. So, yes, you're correct. So, this is basically discounting accounts receivable, right, before due date, right? So, this is called as factoring. Now, all of us understand factoring is on two different bases. One is on a recourse basis, and second one is on a non-recourse basis.
Non-recourse.
Yes. So recourse is where, in case tomorrow the debtor becomes defaulted, it becomes bankrupt, it's not able to repay back, then the person from whom we have taken the discounting, we will have to make good the loss, right? So they have a recourse on us. Non-recourse means they don't have a recourse on us if there is a loss that they will have to bear, right? So, so yeah, students. So these are some of the innovative ways to finance a startup. Please do remember that. I mean, if the question comes and asks you that what are the innovative ways to finance a startup, you need to mention all these points along with some of the theoretical pointers that you can refer from the study material. Although we discussed all of them. Okay. Now the next one is on the unicorn. So okay, students, tell me to whom we call that it is the startup has become a unicorn, or when do we call that the startup has become a unicorn? You would have heard of that, now some of the startups are becoming unicorn, but when do we call it? See, once their business valuation reaches to $1 billion, then it is called as a unicorn. Okay. So it's a benchmark basically. Once this valuation is achieved, they are called as a unicorn. Unicorn means very big startups. So there is a complete list of the unicorns given in the study material, right from the year when they became unicorn. Okay, so you all can refer that. Then there is another important aspect for asking the money, which is called as pitch presentation. Right. So this pitch presentation is actually presented to the investors for pitching the idea of the startup, right? Now, if let's say you are the founder and you have to pitch the presentation, so what all things you would want to include? Come on, students, tell me what all things you would want to include in that presentation if you're pitching for some money, right, from an investor. Come on, think and tell. So you will start with what, first of all? You will give them the context about the startup, right? You will give them the introduction about you as a founder, right? Who are you, what is your background, what is your professional qualifications, all those things, right? So first you will start with introduction of yourself, of the business idea of the startup, all those things. Then you will introduce your team also, right? Because you will not be alone till then. You will have to tell your you have to show to the present to the investors that you have a big team, right, for them. Then what is the problem statement that you are going to tackle, right? Or what is the let's say what is the need that you have identified for the consumer to be immediately attended for, right? For example, the problem will be going from one place to another way in an affordable ride, right? So, or let's say availability of cabs at a affordable prices. So that is the problem, right? Then what is the solution to it, right? How is your startup going to give a solution to that problem? And hence that utility will be there of, let's say, the for putting up the problems aside. Then how will you actually reach out that idea of that solution through marketing or sales, right? How will you actually implement those? How will you strategize that? How can those solutions be penetrated or can be accepted by the different consumers, right? Then you will also say that what is my projections, how much business I project in terms of the P&L, cash flows, and balance sheet. So these three projected statements also one would include while you were pitching for any amount, because you will need to show that after 2 years, 3 years from now, what is my projected P&L and projected balance sheet going to look like, right? Whether I will be making some money, whether I will be a bit positive or not. So all those things will come into play. Then competition, right? Who all are the competitors in that space? Is there any existing player who is a dominant player? So that will give more emphasis on who all are the different players in that industry. Then what is the business model, right? What business model you want to operate in? Do you want to act like a third party manufacturer? Do you want to act like you want to manufacture yourself, right? Or you want some co-packers to run business for you? Or how do you want your selling and distribution to happen? That is all part of the specifics on the business model. And finally, what financing are they asking for, at what valuation, and at what price, basically, right? So these are the components that can be included as a part of the pitch presentation, students, right? Students, just allow me a moment. Just I need a bio break. Just a 1 minute. Yes. So what I was saying is that in pitch presentation, you will have to, or let's say one will include all these things so that it's a robust presentation to be presented. Okay. So the question comes, what are the components of a pitch presentation in a startup finance? So we can add these all, right? Then another question, or let's say the heading of this topic can be the modes of financing for startup. See, above we discussed about the innovative ways to finance a startup. This is modes of financing for a startup. Modes of financing for startups. Okay. See, first of all, there is a term called bootstrapping. See, what do we mean by bootstrapping, students? Bootstrapping is that you make use of resources which are internally available, right? You don't look outside, but you do look inside your business. Now, if you utilize those measures, those are called as bootstrapping modes of financing the startup. What are they? They can be trade credits. See, trade credit, we mean that you ask your vendors for supplying you more credit, right? You go to your vendor and give them, again, you try to pitch them to an idea that they should allow us, let's say, a 90 days period. However, the market norm is 30 days period because we are new, and the supply will be asked on a regular basis. So, basis all those volume of the business, share of business, the trade, the credit related discussion can happen. Then B is factoring. Again, recourse and non-recourse basis, right? This is also an internal way to finance, no? Because bootstrapping is again internal ways of financing, which is factoring, right? Then generally what happens, since you open up a new office, you will need certain assets, right? Or if let's say you are planning to set up a smaller factory, you will need again an asset, right, to operate plants and machineries. So instead of purchasing them, what are the options that are available? Because if you want to purchase them, you will need to have outright funds, right? Bigger amount of funds. That is not possible, right? That is not possible. That is what we are discussing the entire discussion around financing a startup. So what you will do, you will do a leasing. You might evaluate that whether it is okay to lease, whether it is okay if I pay the rent and take certain things on rent, and then if I scale up, I will keep on adding the things. Correct, sorry. So these are some of the internal ways through which you can fund your startup. This is related to the vendor. Okay. This is on the customer. Sorry. The next one is angel investors. Now you would have heard this term angel investor, right? So angel investor is someone who is let's say a high net worth individual first of all, and that person sees a big amount of value, or let's say sees a big amount of let's say potential in one of the idea that a startup is pitching, right? Sorry. And they invest in that startup by giving a huge amount, right? And without any expectation of a return, first of all, because they understand that there is a gestation period initially, right? The returns might not come. So they are okay to forego initial amount of returns. So they are treated like as an angel, right? They're coming as an angel to support your business. That's why they are called as angel investors. So this is again one of the forms of the modes of financing for startup. Then third is venture capital. So students, on this venture capital, let me explain you what is this. See, there are two things. One is public equity. Second is private equity. So public equity is the equity which is issued to the public at large, right? For example, on the stock exchanges, whatever issue of share capital we do, that is called as public equity. Private equity is the equity which is placed privately, right? To some of the individuals. Only some of the individuals have invested in a company, that is called as private equity. Now, venture capital is has to do with the private equity. So private equity, PE, is part of the venture capital. Now, who are venture capitalists? Again, venture capital or venture capitalists are those organizations or those individuals who are interested to do private equity in the startups, right? So they not only provide the funds, right? But apart from providing the funds, they also provide their expertise to run the business. Okay. Now let's understand how. Let's understand it with the help of this chart. So there is a private equity firm that is there. Okay. This is the private equity firm. They float SPV, okay, which is a special purpose vehicle, and it is floated in the form of a trust or LLP. Okay. Now, this private equity firm can be, let's say, any firm which has an objective of investing as a private equity and growing that investment into multifolds and then selling it off, right? So they come with an objective of a multiplier, multiplying the investments and then finally earning hefty amounts, right? So these are the private equity firms which they kind of invest in an SPV. SPV is can be in the form of a trust or LLP. So this SPV will actually raise, will create a pool of funds, let's say, right? They will create a pool of funds. They will invest the amount. See, private equity will lend some of the amount, will create this pool of funds by putting some of the amounts, and also they will oversee the governance of this pool of funds. As I said that these are not only the investment bringers, but they will also do the overall governance. They will do the overall management or governance of this fund, right? Then the funds will also be seeked from other parties, for example, banks, financial institutions, right? Pension funds, where the lot of money sits, right? And then HNIs, individuals, all these people will contribute. to this pool of funds with the objective of investment, right? And they will know that this pool of funds is created by such and such private equity firm, which they will also do some investment. Let's say they have 5% of the investment and they are bringing 95% of the investments. Okay, clear? These are called as limited partners. Why these are called as limited partners? Because their contribution is limited. They have a limited liability to the amount of contribution that they have done, right? To the amount of contribution that they're supposed to do, which is the uncalled part of the contribution, like uncalled share capital, right? So these are called as the limited partners. Then there are some general partners also. General partners are generally appointed from the private equity firms. They are experts in those areas. They are experts in terms of the investments, like investment bankers. They will understand how that industry is operating, and they are generally the decision makers. That where to invest, what to invest, all those things will happen over here. Okay, and collectively they will appoint a manager or an advisor whose role and responsibility will be to manage the entire fund, to evaluate any potential investment opportunities, to advise on those investment opportunities, and manage the entire show. So, on this person's advice, the decision maker can take the decision, who is a general partner, and invest their own money as well as the limited partners' money into different startups. So, startup one, startup two, like this, startup four, howsoever they want to invest, they will invest. Okay. So this is the entire map of the venture capital, right? So this is also one form of funding for a startup. Now, if you see, there is a private equity firm which is involved. SPV they will create, which is their own. Then these are the general partners, and then there is a manager or advisor who is involved. Now, if you talk about what is their objective behind all this, so they have three objectives. One is to buy, second is to grow, and third one is to sell. So buy means that they will invest, let's say, $1,000 today. I'm just giving an example. So through their intervention, they will grow this, right? Let's say they will grow this to 7 times in 5 years. Okay, this is the kind of growth that they will do through their intervention. They will make business reach the newer heights, all those things. So this 7,000, it will become the value after 5 years minus 1,000. They will just exit this investment by selling it off to some of the other, let's say, investor, and they will mint huge amount of money in 5 years, right? So this is the entire objective of the venture capitalist or a private equity firm. Clear, students? I hope this is clear. Please do let me know in case there is any other doubt. Clear? Okay, now there can be different structures of a venture capital, right? So domestic structure is simple, right? So first one is domestic structure. So domestic structure is very simple. All the parties are domestic. Investment is happening domestically. Funds are also coming domestically. SPVs are also domestic. So it happens in domestic territory. All these activities are happening in domestic territory. That is why it is called as domestic structure. Now for the others, other than domestic, we have two different structures. This we call as offshore structure actually. Okay. It is all there in the study material also. So offshore has two parts. One is again offshore. One is the hardcore offshore, and second one is the unified structure. Okay. So the first one, which is an offshore one, is where the SPV is outside India. This party, this is outside India. That is why it is called as offshore, right? But the manager who is managing the funds, or let's say the person who is doing due diligence for the respective investments, they are getting good deals onto the table, right? So those managers are within India, and even the investments are happening in India. For example, the startups in which the monies are going to be invested from these offshore SPVs are based out of India. That is called as offshore structure. In the structure of VCs, these are called as offshore structures. Offshore, why offshore? Because the the entity through which the investment is coming is not located in India. It's located outside India. Clear, students? Any doubt, students, till now? Again, I'm asking. Please do let me know. We will take that up. Okay. The second one is the unified structure. See, again, in unified also, it's one of the offshore structures, right? But why it is called as unified? Because if, let's say, some of the people from India also wants to invest in this entire VC structure, they can do. Apart from what the investments is coming outside, even the investors in India can invest. So let's say the SPV is outside, okay? The investments can come from outside India, plus investments from inside India put together, okay? They will create pool of funds, right? And since SPV is outside, the person whom, again, the manager, this kind of a person in India will be needed, right, to manage the entire show in India. So the this again will be in the form of a trust, and they will invest in India. Okay, they will invest in India on the request, or let's say on the analysis of this manager again, who is based out of India again. Okay, clear? So, as I was mentioning earlier, I think venture capital is one form of private equity, right? See the above chart, this entire chart is for the venture capital, right? And these venture capital are the people who will invest for a three objectives. One is buy, hold, or let's say grow and then sell to mint huge amount of money, right? And this is their idea, right? They will ask all the limited partners to invest some of the monies. They will also keep, they will act as the decision makers because they are experts in those areas. They will make sure that the investment grows in a multiplier effect, and finally, once they reap out the investments, they end up having good amount of money. Then again, we can actually add some of the structures also to this VCs, where some of the outside investment also wants to come in, can come in through these offshores and unified structures. In unified structures, along with the outside investments, the investments from the Indian can also happen, right? And finally, venture capital is one form of private equity. Private equity is a bigger term. Venture capital is a subset of that term. Okay. Now, some of the characteristics of venture capitalists, or let's say venture capital. Okay. Now, the characteristic of a venture capital. One is it have a long term horizon. So the objective with which they invest, it's not only for 1 month or 2 month, right? It is a long term for which they want to invest. Let's say 3 years to 10 years, right? See, because ultimately, I'll tell you, if they're investing, right? So they will seek participation in the equity. They will seek participation in the regular day to day affairs. They will want a board seat as well. So they would want a representative of them to be assigned to the board of directors in that target company, right? So they have a long term horizon. So they just don't want to passively invest and keep, right? They just want to actively being involved in the overall functioning of the company. Then second is lack of liquidity, right? Since they have a objective to invest for longer, they will not get their funds out on a, let's say, immediate basis. So they will, so there is a lack of liquidity. I mean, the returns, or let's say the sell off, will happen later, and hence the element of liquidity in such investments is very small. And then there is a very high amount of risk, right? Because in the venture that they're investing, if it does not takes off, if the ideas is not, executed properly, then there is a high risk that they will end up, losing even their investments amount, right? So there is a good amount of risk sitting in such investments. And lastly, they actually demand for equity participation. That's what we have discussed, right? Because they will again not see themselves as an outsider to the business. They will definitely want to grow the business, right? And hence they will also demand the equity participation just like a normal owner does, right? So that is what the requirement will be. Okay, students. Now, if I just let me go back, see, this is the startup finance that we discussed, students, right? In startup finance, we said that the legal entity, the form of the company, or let's the form, the legal status should be in the private limited company, registered partnership firm, or limited liability partnership, right? And it needs to have, let's say, first 10 years into of its operation, turnover should be up to 100 crores, right? If it is beyond 100 crore, then it will be difficult, then it will come out of the startup definition. Then it should not be formed because of the startup split up or the reconstruction of the existing business, and there has to be some element of the innovation in which, let's say, some of the product processes or services are redefined or redeveloped or improved on a scalable manner with the objective of wealth generation and employment generation. Then we discuss some of the innovative ways to finance a startup. Again, I'm saying students don't get confused between the innovative ways and just now the other ways that we have discussed, right? Those are methods to finance a startup. These are innovative ways to finance a startup. Accordingly, you will have to draft your solution in a similar manner. So in this, you will see smaller ways to finance more personal credit line, personal financing, friends and families, peer-to-peer lending. In this, crowdfunding is something that we have discussed new, which I think some of you, it might be a new concept. Where when we discuss that, there are certain platforms which are running as of now, on which there are thousands of smaller investors are registered, and similarly, the companies needs funds are also registered over there, right? Then some of the internal things, right? Say vendor financing, purchase order financing, and account receivable factoring, right? See, these are some of the older ways also to finance a startup, right? Then In terms of the pitch presentation, also students, we discussed, right, what all things needs to be sorry, included as a part of the presentation, right? And this is just a normal flow. If you are seeking some amounts as the investments, you will want to include all these matters in your presentation. More importantly, your projections, right? How do you project your financial numbers? What is the real problem that you're talking about? Are you very much customer centric or not? Whether you want your problems to solve the real issues for the customers or not. Similarly, for the solutions to be devised against those problems, right? Then we discussed about the modes of financing. So in this, we said that bootstrapping is an internal way to finance, right? It's using the internal sources to finance your startup. Now those are trade credit, right? The easier one. I mean, not the easier one to operate, but easier one to think that at least you can ask your vendors to shift the payment terms. Similarly, factoring your accounts receivable. Similarly, leasing. Let's say if you need good amount of laptops for your teams to work upon initially, rather than purchasing them, you can lease them, right? You can take it on lease. So this will help in reducing some of the financing needs for the startup. Similarly, angel investors we discussed, these are the people who will invest, who sees value behind the idea, right? And venture capital, the entire flow we discussed, how these venture capital organizations works through organizing different parties and hence channelizing those investments into the different startups, right? With these three objectives, and then the two different structures of the venture capital also, and finally the characteristics of venture capital, right? Wherein we said that it is, since it is for the longer term, the lack of liquidity is there, there is good amount of risk because you don't know what is the outcome tomorrow on these investments, and ultimately there is an equity participation, right? Now, with this, we come to the succession planning in business. So, there is one more topic about the succession planning in business. Any doubt, students, please do let me know, or any question you want to discuss, any query. Again, I am asking. So, first of all, what is succession planning? So, succession planning is that for your certain key positions in an organization, you know that if the person who is currently serving into that position, who will be a right successor for that person, right? And let me tell you, it's very important in today's scenario, right? Because there are a lot of factors which gets impacted because those key positions, there is no proper successor involved, right? It can impact your entire ways of working, it can impact your entire business itself, right? So this let's say concept has been gaining a lot of importance in almost all the businesses, right? So this is the background on the succession planning. Now, why, first of all, there is a need for succession planning, right? See, one more thing, if you don't have a succession planning in place, then you will end up ruining your business, right? Because then it will not be in the right hands, or let's say there will be no proper successor to take up the business, right? So, the first part is why there is a need for succession planning. See, first of all, we have to mitigate the risk. Let's say if the existing leader quits, then it will take good amount of time to fill up that position, right? Until that time, the organization might not get that vision, might not that get objective to carry on, right? So there is a risk, and to mitigate that risk, we need to have a succession planning. The risk is leader quitting. Sorry. The second one is cause removal. See, cause removal are those cases where the leader is found guilty of an offense, right? And that leader is removed because of some of the proceedings from the court, or because of the laws, or because of some of the other proceedings, right? So, in those cases also, since the leader is removed or there is a cause removal, there is a need to get a proper successor in place so that tomorrow the business is not disrupted. Then there is a talent pipeline, right? With all these discussions, you tend to build the talent of the organization, right? You keep the people down the level motivated so that they also know that they also have a chance to come into the key positions, right? So this helps in building the entire talent pipeline of the organization. Then it helps in the conflict resolution mechanism, right? So in a way, the most, let's say, capable person is promoted, or let's say there is a open and transparent communication regarding the, let's say, successor will help in resolving any sort of the conflicts. Then lastly is aligning to the overall vision of the companies, right? So that the direction or vision is aligned. So these are some of the factors because of which the business succession planning is very much important, right? And ultimately, how do you do that? See, first of all, in terms of the strategy, right? Business succession strategy. I mean, how do we do this? See, first of all, we have to evaluate key leadership positions. Okay, so there can be lot of roles which are critical, right? Which has a wider impact on the organization. So first of all, those roles or those positions needs to be identified so that no position which is critical is left unidentified. Second is we have to map competencies for those positions, right? Map competency for above positions, right? So what are the skill sets required for discharging those positions, right? Then one, you have that what all positions are there. Let's say there are five positions. For those five positions, you need these competencies. Those are also identified. Once you've identified that, then you will have to see that your current workforce has what behaviors, has what attributes, so that they can achieve the step two, which is the competency required for the current positions, right? So you will try to do that assessment again, right? Identify current competencies, or let's say competencies of current workforce. Competency for current workforce, right? So one is five positions are evaluated. For those five positions, you need these kind of behaviors or attitudes or competencies, and currently the workforce is having these competencies. And then finally, you will have to match them to arrive at a successor, right? You will have to pick and identify, okay, these competencies from the current workforce will help in enabling the succession planning. And sometimes we also see the role of a bridge leader, right? Who is a bridge leader? The bridge leader is someone who will act as an support system for some time the new person who is identified as a successor takes up the leadership role. Okay, students. So these are some of the business succession related strategies, right? Now, some of the challenges are, so if you really talk about startups, so challenges. of succession planning, right? See, the biggest challenge is that the founders are very specific to the startup, right? Because sometimes the people also invest behind the founder's idea, right? So that if the founder is planned to be succeeded by someone, that is the real challenge, right? Because the moment that happens, the investors will lose confidence and they will say that why the succession planning is there, and hence it makes the entire process problematic. Then again, the there are two different mindsets, right? This succession planning would be very useful in the corporate setup, but in a startup setup where certain things are very centric, where founder will would want to drive the things in its own manner, um, and basically the thought process is a little bit different from a corporate setup. So there I think the succession planning will face a lot of challenges in terms of how it gets executed and picked up, right? And for startups, again, because of these two reasons, it's very premature to implement the business succession planning, right? So so students, these are some of the pointers on the succession planning, right? Now we have certain MCQs for all of you to answer, right? These are again from mergers and acquisitions, from the topics that we recently discussed. So yes, now I would request all of you to please put your answers in the chat box and reply on these MCQs. Yeah. So the first question, students, in Dash mergers, the acquirer and target companies are related through basic technologies, production processes, or markets. Yes, students. There are four options: horizontal, vertical, conglomerate, or co-generic merger. Come on, students. All of you can try answering these. We have discussed this today only, the co-generic merger. You can put your responses in the chat box. Yes, students. We are on question number one. So, according to you, what is the correct answer? Whether it is a co-generic merger, conglomerate, vertical, or horizontal? Students, I would suggest if you guys can respond, because these MCQs are for your testing purposes only, so that all of you understand the concepts. So I think people who are there on call: Sahil, Ojajini, Pooja, Kavita, Usha. Okay, so the correct answer for question number one is co-generic merger, because in the co-generic merger the technologies, production processes, or markets are related, right? That's what we discussed. It's not a horizontal merger, it's not a vertical, it's not a conglomerate. Question number two, A dash is the sale of an asset, factory division, product line, or a subsidiary by one entity to another for a purchase consideration payable either in cash or in the form of a security. So that's an easier one, whether it is a sell off, partial sell off, spin off, split up, or equity carve out. Come on, students.
Sell, option A.
Yes, it is option A, correct. It's a sell off or partial set off. Then, question number three, an acquisition of a company or a division of another company which is financed entirely or partially 50% or more using a borrowed funds is termed as. So, this also we discussed today. In case we are doing a mergers and acquisition, in case we are acquiring a company by using a borrowed funds, that is called as what? This was MBO, right? Management buyout, and that was LBO, leverage buyout. So, what do we call it as? Come on, students. That was called as leverage buyout because you are leveraging on the borrowings that you did by doing a buyout. Question number fourth. The main objective of Dash is to raise money despite not having any operations or revenues. The money is raised from the public. It is kept as an escrow account which can be accrued, which can be accessed while making an acquisition. This also we discussed today only, students. Is it a private limited, reverse merger, management buyout, or special purpose acquisition companies? Come on, students.
B option, reverse merger.
B option. No, no. Reverse merger is so. If you again read out the question, the main objective of Dash is to raise the money despite not having any operations or revenues, and the money raised from public is kept in an escrow account. So this was the special purpose acquisition companies, right? Wherein we discussed that they will keep the money in escrow account till the time the deal is finalized. These were also called as blank check companies. Remember that discussion? Anyway, question number five, dash is the form of financing in which a company lends money to one of its customers so that he can buy products from the company itself.
Customer finance.
So, in a way, actually, it's a bit confusing. It is vendor financing though, wherein see if you look it from the customer side, yes, but the way question is drafted, that vendor financing is the form of financing in which a company lends money to one of its customer so that he can buy products from the company itself. No, actually, it should be customer financing if I'm not wrong. You're right. Yeah. Okay, then you're right. So then the last question is which of the following is not a precondition for qualifying as a startup as per the notification released by the government of India? Incorporated within last 10 years, turnover not exceeded with 100 crores, publicly listed companies or innovation of product or processes. So which one condition, if it is there, it will not qualify as a startup, students? What is that?
Not
It's
a
an easier one. Come on. Sorry.
It's not a precondition means it can be it cannot be a listed company. I think option
Correct.
C.
Correct, correct. It is correct, yes. So its option is C. Perfect. So I think this brings us towards the end of the sessions. I would request now see Ashish sir to please help with the concluding remarks. Thank you, sir, and thank you, students. Thank you.
Thank you, Divas sir. Now, student, with this session, we have come to the end of our journey of this LVC batch for the paper Advanced Financial Management paper number 2, CA final level. Now, student, during this journey, I think we have just started our journey somewhere in end of the September, and we have completed our complete course. Now, during this complete journey, some of the students were very active, of course, and their names are, I would like to take their name: Ankita, Ginny Oja, Mamta Kumari, Stephen, Niranjan Kar, Sahil Gupta, Usha Joshi, Pooja Jain, Monica, Harshal, and Nisha Patil and Ankita. Today I noticed one more student, Ankita. Now there is one student who continuously joined the session by the name of Dell 5480 number. It was his number, but never disclose his identity or her identity. No problem, student. But it was a very wonderful journey because the section during the session it was an interactive process, interactive. You can say it was a classes because students were responding in a very enthusiastic manner, and that's also add to the value to the faculty who are delivering the lecture. Now we request the student, if you have any query, please do contact us. Preferably, if you can contact me over the telephone, because from the telephone, it will take you a less time and writing the mail. Although you can write the mail to us. Now, student, as I requested in my in earlier session, I need the only for my official purpose, not for official records only. So some of the students registration number. Although some students have shared, I would like to take their name: Mamta Kumari, Stephen, Niranjan Kar, Usha Joshi, Monica has shared, Harshal, Nisha, and Ankita. If you could share your registration number, it will be very valuable for us because it shows your students' integrity towards the classes. And students, I also thank on your behalf to Dr. CA Divas Gupta ji, who has constantly helped us, and he has made lot of efforts in delivering the lecture, because sometimes even due to the paucity of time, I have requested him, sir, please. So because of it is your love and affection that they say, okay, I will take the classes because of the students. So, students, with this, now there are students in the coming few days. We shall also conduct some sessions on the bureaus for the success. So, there I will discuss with you in detail the examination tips. Of course, we can discuss here as well, but I would like you go through your complete syllabus and start attempting mock tests. Then I will start discussing with you how you can score good marks in your examination. So student, I would like if you could share your registration number with me now, just now, with a private chat on me with me, or you can send it to my email ID. That is, our email ID is sfm-final@ici.in. Jeannie, beta, your registration number is with us already. Don't worry. That dot ici.in. I just erase this here. This is ICAI.in, or you can then contact me over the telephone number 0120. This is STD code. Okay, student. So now it is very important. Uh, let's have a pic of the same. Pic लेते रहो सबके. So, and very important here, if you have any query, and I would like to discuss a very important aspect that in our classes, our basically we were insisting on conceptual clarity, because once you develop the conceptual clarity, we shall. It is a very. It will also help you to score good marks in the examination, because sometimes the same question cannot come in the examination. In the beginning of the class, there was one suggestion from a student, that is student Stephen. He has suggested, sir, the solutions of the assignment. Student, please note that most of the questions are from your study module. However, it is a very good suggestion that for questions that has not been covered in the assignment, that has not been covered in study module, their answer, we shall host their answers separately to help you out. Okay, in any case, if you have any more suggestions, please do send us so that we can make our classes more better for the student. So student, with this, I convey my best wishes to from my complete best board of studies team, and in my team there is a CA Kavita Rana, and from technical side I have with me Mr. Ajit Kumar, who has constantly uh, put a lot of hard work in arranging the starting the class at 7 a.m. in the morning. I really thank you, Ajit, from my core of my heart. So and student, with this, best of luck you for your examination, and I hope you will come with the flying colors, because next time when we will interact, I hope will not be more student, you will be a chartered accountant. And Divas sir, thank you very much for
Thank you, sir.
sparing your precious time.
Thanks a lot, sir, for the opportunity. I would like to thank the entire Board of Studies, you and everyone for the opportunity. And I would like to pay best wishes to all the students. Please do take revision. And yeah, thank
Yes,
you.
thank you.
हेलो
Okay,
सर।
student. Yes, yes.
सर मुझे थैंक यू बोलना था कि आपने हमें इतने अच्छे लेक्चर्स प्रोवाइड किए और इतने अच्छे टीचर्स प्रोवाइड किए कि हम उन्हें बार बार पूछते हैं और वो हम पे कभी गुस्सा भी नहीं करते कि आप हमें
Certainly,
एक
बेटा
ही
देखिए,
चीज बार बार पूछते हैं।
नहीं, देखिए बेटा, क्या होता है मैं आपको बताता हूँ। जो टीचर होता है ना, उसका जो टीचर होता है वो स्टूडेंट ही होता है। यू थिंक, मैं ये मानता हूँ कि मेरा जो टीचर है, अगर कोई मेरे से कभी स्टूडेंट ने पूछा कि आपके गुरुजी कौन है, तो मैं कहता हूँ आप ही हो बेटा। बिकॉज मैं स्टडी मटेरियल में भी बच्चों को मैं हमेशा एक ही बात सजेस्ट करता हूँ, कहीं से स्टडी मटेरियल में आपको कुछ कंट्राडिक्शन लग रही है, प्लीज डू कॉन्टेक्ट मी, बिकॉज समटाइम मेरे से एरर रह सकती है। तो आप लोग ही हमारे गाइडिंग फैक्टर्स हैं, तो आप जब तक नहीं पूछेंगे, हमें नहीं पता लगता कि हम कहाँ जा रहे हैं। सो इट वॉज ए वेरी वंडरफुल एक्सपीरियंस यू विद ऑल योर स्टूडेंट्स। और बेटा, जब भी आपको कोई प्रॉब्लम हो SFM या इवन इंस्टीट्यूट में कोई और भी आपको कोई ऐसा इशू आ रहा है, प्लीज डू कॉन्टेक्ट मी। ओके, आई विल ट्राई टू सॉर्ट इट आउट द सेम।
जी सर।
ओके बेटा। ओके
थैंक यू
स्टूडेंट।
सर, वी विल रियली मिस यू
No problem, beta. We will always be in touch. I will be always be in touch. Okay, don't worry. My
सर,
number is. Yes.
सर आई वाज थिंकिंग, अगर पॉसिबल हो तो महीने में एक या दो बार अगर हमारा शेड्यूल मीटिंग हो सकता है सर, जिसके थ्रू हम सभी स्टूडेंट्स जो भी है इस LVC में कंटिन्यू थे,
हाँ,
हम
हाँ,
एक बैच बना सकते हैं। जैसे कि अपने टोटल SFM में 13 या 14 चैप्टर्स है
हाँ,
फर्स्ट
हाँ,
टाइम।
हाँ।
तो हम अगर 5 चैप्टर्स के रिवीजन कर
Okay.
अगर उसके बाद भी
Wonderful
कोई
suggestion.
डाउट्स होते हैं तो हम
So,
डिस्कस कर सकते हैं।
very good suggestion, beta. I think today I just work out on the same, and
हम्म,
I think we shall conduct 3 revisionary sessions. Okay,
यस
don't.
सर।
Okay, it will be a wonderful session. I will try to arrange somewhere around in. मतलब I think you suggest me the time, because it is a
ओके,
you just send me the time when you want, so accordingly I will arrange the same. Don't worry. I will.
ओके सर।
Okay. Or you need any help from our side, we are here to help you around, beta.
Okay, sir.
Okay.
Thank you for your wonderful and valuable
Okay.
time and efforts.
My pleasure, my pleasure. Okay, beta. Thank you, beta. Thank you, best wishes.
थैंक
Okay.
यू सर।
Thank you. Thank you.
Okay, thank you. Thank you.
सर,
Yes,
थैंक
beta.
यू सर, थैंक यू सर।
सर एक्चुअली हमारे पास जो अभी टाइम टेबल है वो सिर्फ अभी 31 दिसंबर तक ही अवेलेबल है, तो फिर
आ जाएगा बेटा, आ जाएगा, 1-2 दिन में आ जाएगा।
ओके सर, ओके।
आज आ जाएगा, डोंट वरी। तो एंड सबसे पहले, हाँ, लास्ट में एक मैं थैंक यू करना भूल गया। हमारे अशोक जी हैं, जो जिन्होंने बहुत हेल्प करी है। वो मतलब अशोक जी का एक वॉइस सुनता था, सर स्टार्ट कर रहे हैं, तो ही मेरे स्टार्ट होता था। थैंक यू अशोक जी फॉर योर ऑल द एफर्ट्स। एंड आई थिंक पिछले कई सेशन से आपके साथ ही एसोसिएटेड हूँ मैं। थैंक यू। चलिए सर। ओके सर, ओके सर, हैव थैंक यू।
Okay,
थैंक यू
sure.
एवरीवन।
थैंक यू,
थैंक यू
थैंक
Thank
सर।
यू
you.
सर,
Thank you. Have a
थैंक
nice
यू।
day.
थैंक
Thank
यू।
you.
थैंक यू देवर सर।
Thank you. Thank you. Thank you
Thank
all.
you, sir.
Bye.
यू बेटा, थैंक यू। 2 मिनट रुक जाइए, वही अगर स्टूडेंट का और देते हैं। ओके, ओके अशोक जी, सेशन ओवर। ओके अशोक जी, यू कैन वाइंड अप द सेशन, थैंक यू।